Have you ever wondered whether the bustling economy is truly as robust as it appears, or is it simply a bubble waiting to burst? Welcome to the fascinating world of asset bubbles. Economic cycles where the price of an asset, such as property or stocks, inflate rapidly and often irrationally, only to crash and leave financial chaos in their wake. One of the most legendary asset bubbles in history is the Tulip Mania of the 17th century. The year was 1634, and the Netherlands was caught in the grip of a frenzy over a flower, the tulip. This was not just any flower, but a symbol of affluence and status that was about to create an economic storm like none other. The tulip, a beautiful yet simple flower, had been introduced into Dutch society only a few decades prior. But its vibrant colors and rare patterns quickly enamored the wealthy, turning it into a luxury item. The tulip's rarity, coupled with the Dutch Golden Age's economic prosperity, set the stage for an unprecedented economic phenomenon, the Tulip Mania. By the early 1630s, the tulip trade had begun to flourish, and with it, tulip prices soared. The allure of quick wealth led to the introduction of tulip futures contracts. Essentially, these were agreements to buy tulips at a future date at a specified price. They were bought and sold, often for astronomical sums, before the bulbs were even out of the ground. Then came 1637, the peak of the bubble. Single tulip bulbs, especially those of rare varieties, were being traded for prices equivalent to houses. Some bulbs were even valued more than most people would earn in a lifetime. This was a time when a single flower held more value than a skilled craftsman's years of labor. But as quickly as the tulip prices skyrocketed, they plummeted. The market suddenly collapsed in February 1637. Traders could no longer find buyers willing to pay such exorbitant prices. Panic ensued, as people who had invested their life savings into tulips found their wealth evaporated overnight. Those who had sold their homes or farms to invest in the tulip market were left destitute. The economy was in chaos. The government stepped in, but their attempts to resolve the crisis were in vain. The damage was done. The tulip, once a symbol of wealth and prosperity, had become a reminder of irrational exuberance and financial ruin. And just like that, the first recorded speculative bubble had burst, leaving economic chaos in its wake. The Tulip Mania serves as a timeless reminder of how quickly fortunes can change when speculation and greed overtake rational judgment. Fast forward to the 21st century, and we find ourselves in an eerily similar situation. Just as tulip bulbs became the object of speculative frenzy in the 17th century, we've seen modern equivalents in the form of the housing bubble of 2008 and the dot-com bubble. Take the housing bubble, for instance. Much like the Tulip Mania, there was an irrational exuberance, a belief that housing prices would perpetually rise. And when the bubble burst, it led to a global financial crisis, echoing the economic shockwaves of the Tulip Mania's aftermath. The dot-com bubble, too, bears striking resemblances. At the turn of the millennium, internet companies, even those without profitable business models, were the tulips of the day. Investors clamored to buy into the digital revolution, pushing valuations sky high until the bubble inevitably popped. While the asset may change from tulips to tech stocks, the underlying human emotions of greed and fear remain constant. So how can we as investors navigate these treacherous waters? That's the question on everyone's lips, isn't it? Well, ladies and gentlemen, allow me to introduce you to a nifty little tool called the Shiller PE ratio, also known as the CAPE ratio. Imagine having a crystal ball that could provide a glimpse into the financial stability of a company, or even the entire market. The Shiller PE ratio may not be a crystal ball, but it comes pretty close. It's a tool that allows us to compare a company's current price to its earnings over a 10-year period, all while adjusting for inflation. Quite the handy tool, wouldn't you agree? But how does this relate to potential asset bubbles, you may ask? Well, when the ratio is high, it implies that the company's stock is overvalued, and thus could be in a bubble. Conversely, a low ratio can indicate that the stock is undervalued. By keeping an eye on this ratio, we can identify potential bubbles before they burst and wreak havoc on our portfolios. And here's the real beauty of it. The Shiller PE ratio can be applied to individual companies or the market as a whole, making it an invaluable tool for investors looking to avoid getting caught up in the next bubble. By understanding the past and using tools like the Shiller PE ratio, we can better equip ourselves to make informed investment decisions and perhaps avoid the next Tulip Mania.